Patrick, let's talk about interest rates and the effect on closed-end funds. For starters, can you talk about a few ways that interest rates or changes in interest rates can affect a closed-end fund?
Yeah, first and foremost, interest rates will impact the net asset value of the fixed income closed-end funds that are out there. About 2/3 of all closed-end funds are fixed income closed-end funds. So to the extent those fixed income funds have duration in their portfolios, they will obviously react negatively if interest rates go up. The second way that closed-end funds are impacted by interest rates is typically from a sentiment perspective. And what I mean by that is that because a lot of closed-end fund investors know that there's duration in their portfolios, they'll overreact and there will be more sellers than buyers, which will push discounts out on closed-end funds.
Patrick, since many closed-end funds do incorporate leverage as part of their capital structure, does the level of interest rates or a change in interest rates affect the leverage component?
Well, it does. Number one, that'll definitely enhance the reaction that the net asset value will have based off of where interest rates go. So, obviously, it could be a double-edged sword from utilizing leverage. But then secondarily, also the yield curve will impact the results as well. What I mean by that is most closed-end funds borrow short-term and they invest longer down the curve. So a steeper yield curve is a lot better for closed-end funds because they're borrowing short, so paying short-term rates to borrow that money and then investing in longer-term rates. So you want a steep yield curve. A flat yield curve, or even worse, an inverse negative yield curve would be a poor environment for closed-end funds.
So by far the most popular question we get in the field from investors and potential investors is, what might happen to closed-end fund discounts if rates were to rise? We are at a 2% 10-year environment. There's a lot of talk about tapering going back to the middle of 2013. So can you share your thoughts on what might happen if and when rates do rise?
Yeah, I think we need to back up to 2013 during the taper talk and what occurred then. I mean, we started the year actually with most fixed income funds trading at a premium to their net asset value. And frankly, the 10-year was at its low around 1.6 then. And lo and behold, during the taper talk, what occurred, that there was an overreaction and those premiums went to significant discounts. So closed-end funds have stayed at these wide discount levels since 2013. What that means to me is that closed-end fund discounts are pricing in the fear of interest rates moving up. And I think what you're going to see is probably when interest rates actually do go up, maybe a lot of those the discounts will narrow because the net asset values could actually go down. But you have some margin of safety because where discounts are today.
Patrick, is there any historical precedence for this? I know we've been in a bull market for interest rates for about 30 years, but is there any historical precedence that you've looked at?
Yeah, so if you go back to 2004, that's the last time the Fed really ratcheted up rates. And so when they were indicating that they were probably going to start increasing rates in early 2004, you saw almost virtually the same thing that we saw in 2013. Fixed income closed-end funds started at a premium and went to a significant discounts, i.e. around 8% discounts to their net asset value. And then from 2004 to 2006, as the Fed did ratchet up rates quite drastically, discounts narrowed. And so that was, I think, almost identical to what we saw in 2013 with the taper talk starting. But we haven't obviously seen Fed funds rates increase yet, but that future will tell us what happens then.
So Patrick, in sum, I guess I hear you saying the market has repriced to some degree, looking for an interest rate rise. So investors in the market shouldn't be too surprised if rates actually do rise sometime, this year or next.
Yeah, I mean, I think that's inevitable when they do rise, right? Everybody knows that's not a secret that rates are going to rise at some point. But I think by investing in a lot of the closed-end funds that are out there today, you're getting a margin of safety because where discounts are. Frankly, there's a lot of fixed income funds trading at double-digit discounts, i.e. 10, 12, 11% discounts to their net asset value. So you're getting a margin of safety by owning closed-end funds for when rates rise. If rates don't rise, and we're here for a long period of time, which some pundits might say, you are getting paid to wait by owning an asset class at more of a discount than if owning those bonds directly.